Good morning. Today we're going to start our chapter 2, which is overview of the financial system. In this chapter, we will be going over in a lot of detail some of the concepts that were very briefly touched upon in chapter 1, which was our introduction to the overall financial system. Let's look at what are financial markets. Financial markets, remember, are a main component of our financial system. Main purpose of financial markets is that they would channel funds from economic players or agents who have surplus funds to those who have a shortage of funds. We call these people with surplus funds as the lenders or savers of our economy, and financial markets are going to connect the savers, lenders of our economy to borrowers or spenders of our economy. Direct finance would be when your borrowers borrow funds directly from the lenders in the economy. This is primarily done through purchase and sale of securities. It is the borrower which issues the security, and it is the lender which purchases the security. So in direct finance, they will just meet together and exchange of security would occur, thereby ensuring exchange of funds. A security, remember, is the thing that is being exchanged in your financial market. Security can be an asset and a liability at the same time. It would be an asset for the party which is purchasing the security. So in our case, that would be your lender. And the same security would be a liability for the party which is issuing the security or is borrowing funds. So we can write that down. So it is an asset for the party which has purchased the security, and the same security is a liability for your borrower or the person who has sold the security. Now, how do financial markets promote efficiency? Financial markets are excellent at promoting economic efficiency because they are reallocating your idle capital. So remember, we have savers who have surplus funds, but they might not be risk loving or might be not equipped to handle risk properly. So they do not know how to use that capital efficiently. Once they have lent those funds out, or in this case, purchased a security, funds are now transferred to the borrowers who are better equipped to handle risk, and they will now use those funds for further economic activity, for pursuing different type of investment projects, etc. So we see a better allocation of capital happening in your economy, higher investment in your economy. Overall, your output will be higher, GDP will grow, and economic activity will see an upturn. Now, your financial markets are also improving the well-being of your consumers. And to understand that, you can take a very simple example of a young family want to buy a new house. And the value of the house might be well above their overall income, might also be well above their overall accumulated savings. So it may take many years, or in some cases, they might not ever have the funds available to purchase a house at its face value. However, financing or borrowing in this market will allow this young family to purchase that house today. It allows consumers to better finance their consumption spending, and they can reallocate their consumption from future time periods to current time periods. So it's not only promoting your investment in the economy, but it's also promoting higher consumption spending today. This is a diagram right out of our textbook. It summarizes very nicely how direct finance, which is your finance undertaken by your financial markets, is connecting your savers and borrowers. If you see over here, we have your different type of lenders and savers, and these guys can be your households, your business firms, it can be the government which is saving, it can also be your foreigners. So any people who are participating in this economy have surplus funds. If they channel these funds through financial markets, they reallocate these funds from themselves to these borrowers, spenders over here. Now, some examples of direct finance are when your corporations issue new stock. So we have Uber as an excellent example, issued initial public offerings in 2019. We saw Lyft, which is a competitor of Uber. We also saw your Beyond Meat company issuing new stock. So over here, these are examples of all companies in this particular example, which had their initial public offerings in 2019. Now, it could be existing corporations with existing stocks out there which are issuing new stock. So Tesla could issue new stock, and that would again be their a new public offering. Whenever a company issues new stock, it raises finances for its investment opportunities. Your previously issued stock by a corporation will not get you any external funds. So that's one thing to remember, that it's always newly issued stock that raises financing. Now, in order to understand the structure of financial markets, we can think of them as debt markets versus equity markets. Debt markets would be simply those markets in which debt instruments are traded. Now, what are debt instruments? Debt instrument basically lays out a contract between a borrower and the lender. Borrower, remember, is the issuer of the security. In this case, it would be a debt instrument like a bond. And the lender is the party which is purchasing this bond. Now, a debt instrument like a bond will typically offer regular payments till some maturity date. Maturity date can be less than a year. In this case, we would call it a short-term debt instrument. It could be anywhere between a year and 10 years. In that case, we would classify this as an intermediate term bond or intermediate term debt instrument. And if the maturity is over 10 years, these would be your long-term debt instruments. Versus debt markets, equity markets are markets in which your equity is being traded. The most common example of your equity is your common stock. What is the common stock? Common stock is simply a claim on the net income of a corporation. In this case, there is no maturity date. There are some stocks that will pay you dividend payments, so you might have periodic payments being paid to the equity or shareholder. Now, what are the pros and cons of holding equity securities? A very obvious pro should be that as the corporation does well, it's earning higher income, making more profit, its stock prices are rising, the equity holders will also benefit along with that. So higher the valuation of the company, higher is the valuation of the stock that you are holding. However, the biggest con is that as the company starts doing bad or overall it's losing its valuation, your stock price will also tumble along with that. Another thing to remember over here is that equity holders are residual claimants. So let's write that down. They are what we call residual claimants. Now, residual claimants means that the equity holder will only get back their money, or they are liable by the corporation to be paid a share of their profits only after the corporation has paid off all its debt and it has paid off all its obligation to the government, so taxes, etc. In the event that the company is doing bad, it's going underwater, its stockholders as residual claimants might end up losing all of their money that they were holding in the form of stocks. Another way to categorize our financial markets could be in the form of primary or secondary market. What are primary markets? Primary markets are those markets in which newly issued securities are sold. Primary markets are not very well known to the public. They are very private. Investment banks play a huge role in primary market. They are the platform on which these newly issued securities are typically exchanged. Investment bankers provide a service in the form of guaranteeing the price of these newly issued securities, and this service is referred to as underwriting. And for providing this service, investment bankers charge a very high fee. Again, remember, it won't be your unknown small corporations that will be able to participate in the primary market. We typically see large corporations, well-known corporations who are participating in primary market. So not any company out there or small business can go out and issue new stock. Secondary market versus primary markets are markets where previously issued securities are exchanging hands. They are being bought and sold. So it can be like your used car market. In this case, it's your previously issued securities that are now exchanging hands. Secondary market agents, here I have listed brokers and dealers. Brokers are agents of investors. They match the buyers and sellers of these securities. Since they're agents of investors, their primary purpose is to look out for the well-being of the people who are purchasing these securities. Dealers, on the other hand, are simply linking buyers and sellers, and they are not agents of a particular party, and they help buy or sell securities at some stated price and not negotiating better prices for the investors. What are the advantages of secondary markets? Secondary markets are very important. To understand that, visualize a corporation which is issuing new stock in order to raise additional capital. If this company, let's say it's Tesla or Microsoft, has already stock flowing in the secondary market like the New York Stock Exchange, it becomes a lot easier for this well-known corporation to issue additional stock. Why? One, their stock is very liquid. It's already exchanging hand between buyers and sellers. So people know even if we were to buy this newly issued stock, we will be able to liquidate it anytime we need to. Secondly, it will be very easier for them to set the price of this newly issued stock, because the secondary market is already determining the valuation of that stock for them. So whatever is the price of the stock in the secondary market, that will automatically become the price of the stock in the primary market. You can think of this as an example where, let's say, the price of stock is $12 a share. Now, Tesla would never want to, and this is just a hypothetical number, Tesla would never want to issue new stock at a price lower than $12, where they would not accept any price lower than $12. Whereas the buyers of this initial stock will not accept any price higher than $12 because they know this stock is already trading at $12. They would not be willing to give up any penny above $12. So there are two main advantages of secondary market. They set the price of additional stock that you're issuing. And secondly, it makes the stock much more desirable to hold because it makes that stock much more liquid. We can also organize our secondary markets as exchanges or over-the-counter markets. So exchanges and over-the-counter markets are simply subcategories of your secondary market. Now, what are exchanges? Exchanges are where your buyers and sellers meet in one central location. You can think of it as a market platform where all trade will occur. Toronto Stock Exchange, New York Stock Exchange are perfect examples of your exchanges. We also have exchanges for your commodity markets like wheat and oats. In Canada, we have the ICE Futures Canada for bulk wholesale purchase and sale of our commodities. Over-the-counter markets are where dealers are present at different locations and they buy and sell these securities at stated prices. So we do not see a lot of negotiation happening in your over-the-counter market. Securities are exchanging hands at stated prices through dealers. Most of Government of Canada bonds, your treasury bills in USA and federal government bonds in Canada, are exchanged through over-the-counter markets. You can also think of your foreign exchange markets. If you're buying foreign currency, you will just simply go to a foreign currency dealer, which would be example of an over-the-counter market, and he will sell you that currency at the stated price. Whatever is the market rate today, you will be able to purchase those foreign currency units at that stated price. Lastly, we can categorize our financial markets as money versus capital markets. Now, this criteria also distinguishes securities based on their maturity. And as you can see on my PowerPoint over here, any security with a maturity date of less than a year, and if it is a debt instrument, that would be exchanging hands in a money market. Capital markets, on the other hand, are your long-term securities. These could be your long-term debt instruments and also your equity instruments. Remember, equity instruments do not have a maturity date. They last forever. So if a corporation lasts for 100 years, your dividend payments are going to come to you for another 100 years. Or the stock you're holding, as long as the company exists, it is good for another 100 years or into perpetuity. So we are distinguishing, remember, money market and capital market based on their maturity and on their liquidity. Typically, you'll see more liquid instruments in your money market. Some money market instruments over here are your Government of Canada Treasury bills. Now, Treasury bills can have a maturity of over a year, more than 10 years. Those are your long-term Canada bonds. They are not going to be traded in your money market. Over here, we are only looking at your Government of Canada bonds, which are 3-month maturity, 6-month maturity, 12-month maturity. So it has to be under a year. Likewise, the US Treasury bills in USA are the safest security for these corresponding to economies. So very safe, very liquid. There are many people who are buying and selling these securities in secondary markets. Next, we have certificates of deposit. Certificates of deposit can be of two types. We have negotiable certificates of deposits versus non-negotiable. Your certificates of deposits, which have a maturity of less than a year and are in bearer form, they're typically called your negotiable certificates of deposits. These are typically issued by your chartered banks or financial institutions to raise funds. So you can think of as a fixed term deposit for 5 years. So that would be a non-negotiable certificate of deposit, and it would not be in our money market. Bearer form negotiable certificates of deposits are very liquid because you can always liquidate them in the secondary market. Since I have categorized them over here under money market, remember these have to be maturity of under a year, and your negotiable ones which are in bearer form. Then we have commercial paper. Commercial paper is another short-term debt instrument issued by corporations to raise emergency funds. So let's say a company needs $50,000 to pay for its salaries. They can issue a short-term paper or called commercial paper to raise that amount. Now, commercial paper is not secured, so it does not have any collateral tied to it. Collateral is when the borrower pledges some amount or some asset that in the event of default, this collateral will make up for the lender's losses. Now, commercial paper does not have any pledged collateral, so they are also called unsecured debt. So there is a risk of holding commercial paper as a lender. However, they are very commonly used by banks and large corporations for raising emergency funds. Again, the maturity date is typically less than 6 months, so that's why they're in our money market instrument. Repurchase agreements are your secured debt. Over here, we are using, again, short-term loans, debt instruments. But over here, the typical collateral is Government of Canada Treasury bills. Or if you're in the US, the US Treasury bills. So there is some posted collateral. Whenever we post collateral, this would make it a secured instrument. So repurchase agreements are again used by banks and corporations to raise very quick short-term loans. The term to maturity are very small, typically 2 weeks. Overnight funds are your last category over here. The equivalent of overnight funds in USA would be your federal funds. So this is the market where banks are borrowing from each other in order to raise additional funds. Now, this could be because of a large unexpected drain on their deposits. So typical bank ABC wants to raise now additional funds because they saw a huge unexpected withdrawal from their deposits. So overnight funds market is where banks are borrowing and lending from each other. The interest rate which is determined in this market is called the overnight interest rate. So it is your IOR, and its counterpart in USA is your federal funds rate. So just the name is different. Pretty much the way they both work are exactly the same. Overnight funds market is the market for chartered banks in Canada, which they use to borrow funds from each other. Federal funds market is the market in USA where banks in USA borrow from each other. Collateral is typically in the form of federally issued treasury bills. So in our case, in Canada, it would be your Government of Canada bonds, which are posted as collateral. The term to maturity over here is again very small, typically only 2 weeks. Then we have some examples of capital market instruments. The most common capital market instrument is your stock or equity shares. Then you can also have your mortgages and mortgage-backed securities. Remember, mortgages have a maturity date of more than 10 years, and that's why it is now a debt instrument, but categorized within your capital market. So any debt instrument with the maturity date of more than 10 years, long-term securities, are going to be your capital market instruments. Corporate bonds with longer term maturity dates are traded within capital markets. Then you have long-term Government of Canada bonds. They are very safe. So the interest rate that they offer you out of all of these other examples would be the lowest. The lower the risk associated with the security, the lower will be the interest rate associated with that the lender is earning. Then we have Canada saving bonds. They typically have a maturity date of 5 years or more. We have provincial and municipal government bonds with long-term maturities. Again, these are debt instruments but categorized under capital market instruments because of their longer-term maturity dates. Consumer and bank loans, because have again maturity dates of more than a year, will also be categorized under your capital market instruments. A lot of finance and financial markets are now happening across borders. Let's look at some of these instruments that are traded across national boundaries. Foreign bonds are bonds which are sold in a foreign country and denominated in that country's currency. So for example, a Canadian company can issue bonds, but is selling these bonds now in the United Kingdom, and the bonds are denominated in the British pound sterling. So that is an example of a foreign bond. Euro bonds are bonds which are quite similar to foreign bonds, but they are quite distinct from them in a particular way. And let's go ahead and see what is that difference. They are again sold by a domestic corporation or by the government, but they are sold to foreigners, or they're sold in foreign countries and not sold domestically. They will be denominated in a particular currency, but they will not be available to be purchased in the country of which denomination you are using. So for example, we can say US company issues bonds in the United Kingdom, and now these are denominated in US dollars, not necessarily in British pound sterling, but they are denominated in US dollars. And the domestic investors in United States will not be able to purchase these bonds. So a euro bond issued by a US corporation will not be available for purchase in USA, but is available worldwide, and its denomination is in US dollars. These are particularly recent development, and they have become highly popular. 80% of the bonds are in the form of euro bonds. Very recently, the government of Pakistan issued euro bonds, and these were floated, denominated in US dollar in Europe, in UK and elsewhere. And the primary reason was that with the developing economy, weak currency, foreign investors might not be attracted to those bonds denominated in the local Pakistani rupee. And as soon as you issue these bonds in the US dollar, because it's a much more stable currency compared to the Pakistani rupee, US dollar has also been appreciating over time. Investors would be now more willing to hold these bonds, making it very easy, or now relatively easier for the Pakistani government to raise external funds. So we see a lot of this happening, especially with large multinational corporations, and also for government debt. A lot of governments use this option to attract foreign investors. In your international markets, we also have what we call euro currencies. This is a variation of the euro bond. In this case, your foreign currency, not a typical debt instrument, but the foreign currencies are deposited in your bank accounts abroad. Let's say I'm a Canadian company, but I am now depositing US dollars outside of my home country. So that is now a euro currency. Euro currency does not mean that all of these currencies would be denominated in euros. I'm only holding foreign accounts in euros. It could be US dollars, it could be any other currency, but it's not my domestic currency, and I'm holding it abroad. I'm not holding it locally. Typically, euro currency is also called euro dollars because a lot of people like to hold dollars abroad. So they would hold their US dollars deposited in foreign bank accounts outside of the USA. And these type of things are typically done in order to overcome regulatory requirements at home. Mutual funds, hedge companies, large banks, and sometimes people who are trying to evade taxes or evade local domestic regulatory requirements will, hold euro dollars or would want to participate in euro bonds. So the ones that we just talked about earlier.